Hello and welcome. You're watching the Global Reset on CNBC TV 18 Prime with me, Prashant Nair. This is the program where we try and connect the dots between economies, markets, trade and technology and bringing the experts to analyze the top stories for you. On the show today, we've got a very special voice, a contrarian voice on something which is a consensus view right now. We'll be speaking with Willem Buiter. He used to be the chief economist at Citigroup. Now he's an independent economic commentator. And the conversation, as I told you, is around gold. William believes that gold is in a 6,000-year-long bubble. He's asking central banks to sell their gold and diversify. So, coming across to you, William, in just a bit from now. But before we go across to William, as always, let me get you a quick recap of what has happened on the global front so far. So, starting, of course, with Donald Trump's visit to Japan, the U.S. president met with Japan's newly appointed and first female prime minister earlier today and signed a framework agreement for securing the supply of critical minerals and rare earths through mining and processing after a bilateral meeting in Tokyo. The pictures are up on your screen. The countries plan to cooperate through the use of economic policy tools and coordinated investments to accelerate development of diversified, liquid and fair markets for critical minerals and rare earths, the White House said in a statement. Trump and Japan's new Prime Minister, Takaichi, will later visit the U.S. naval base in Yokosuka, near Tokyo, which is home to the aircraft carrier USS George Washington, part of the U.S. military's powerful presence in the region. Trump will then meet business leaders in Tokyo before traveling on Wednesday to South Korea. Well, from Japan to the other big story, which of course is China. The U.S. President Donald Trump is set to meet with his Chinese counterpart, President Xi Jinping, later this week on Thursday. Now, ahead of that meeting between the two leaders, the U.S. Treasury Secretary Scott Bessent said this. He said that Trump's threat of 100% tariffs on Chinese goods is effectively off the table. He added that a very successful framework was in place for when both leaders, that is President Trump and President Xi, meet later this week. Well, I think that's the big global story. I mean, thawing of relations, at least no fresh hostilities between US and China seems to be what markets around the region are focused on. Now, away from trade and, sort of talks there, investors will also be focusing on a few other things which could be market moving. 5 out of the magnificent 7 companies in the US, that is mega tech companies, are due to report their third quarter earnings this week. So Meta, Microsoft and Google are set to report on Wednesday, while Apple and Amazon are slated to report their earnings on Thursday. Also keep an eye out on central bank action. The US Federal Reserve begins its 2-day FOMC meet today. A decision will be announced tomorrow, which of course for us here in India will be Thursday morning. There is also the ECB and the Bank of Japan, which are also set to take their interest rate decisions later this week. Investors are widely anticipating a quarter-point cut in interest rates this week from the US Federal Reserve on signs of a slowdown in the job market and easing domestic prices. There is also growing consensus that the Fed will announce an end to its quantitative tightening program on Wednesday evening, that is US time. Okay, as promised now, that's the global news. Let's move across to the conversation for the day. We're joined now by Willem Buiter, a rare contrarian voice standing against the consensus bullishness on gold. Since 2009, when gold was about $1,000 an ounce, Buiter has labeled it a 6,000-year-old bubble driven by myth rather than value. Since then, gold has surged 4 times. And I point that out to William and ask him for his response. So from $1,000, gold's now at $4,000. That is a 16-year period. Yet, Buiter remains steadfast. His advice now, he urges central banks, which have been such big drivers for this last $2,000 move in gold prices, he asks central bank, urges them to sell some of their gold reserves, calling them thoughtless prisoners of history. He warns they are holding a costly, low-value relic instead of investing in modern, efficient financial instruments. According to Buiter, central banks must rethink gold as monetary insurance and trim these bubbles, as he calls it, to focus on real economic value. Let's actually hear it straight from Willem Buiter. Now, William, great to have you with us here. Thanks very much for joining us here on the program. Let me start by asking you, you've referred to gold as a 6,000-year bubble, in a 6,000-year bubble. Yet, as I just pointed out, gold prices from when you first made that comment are up 4 times. And they've done very, very well this year as well. What's going on? Why not change your view, William?
The increase in the price of gold since the beginning of the year is now close to 50%, which is extraordinary. And of course, if you take a longer view, like from 2015, it was trading at just over $1,060, now at close to 4,200. Gold is mostly a purely speculative commodity. It has very little intrinsic value, either as a productive input or as a consumption good. This boost in the price since in the beginning of the year, slightly longer actually, really since the start of the Ukraine war, is due to central banks outside the G7 being concerned that the US dollar, the main foreign exchange reserve currency and international transactions currency, can be used for sanctions against the country. And indeed, in the case of Russia, the reserves could be frozen and possibly expropriated from them. So there has been this flight by central banks into the historical central bank reserve currency. There's no reason why gold should be an international reserve currency. Central banks decided, they are because it has been, which is not a fundamentally strong reason, but we are likely to see, as international tensions continued central bank demand for gold, reinforced by speculative followers in the private sector who view gold, which I have described as shiny Bitcoin, as something they can't miss out on.
Got that. William, as you mentioned, what is now being described as a dollar debasement trade, right? Pushing investors into gold, digital assets like Bitcoin, etc. You think it makes sense? It makes no sense?
Dollar divestment may make sense if you fear that the dollar is going to be used strategically for sanctions and other risks are posed to your dollar holdings. So clearly diversification out of dollars makes sense then. But I would go into a portfolio of alternative currencies. So you're not going to trade with gold as a physical commodity. Gold is kept in central bank basements. For transactions, you should go for non-dollar currency transactions, electronic, digital, not believe that you can somehow make gold a substitute for the dollar. It may be as a store of value, although I think it is much more speculative, but certainly as a transactions medium, it is completely useless.
Yeah, William, but just to press on that point a little longer, the term debasement trade, it reflects a combination of factors, right? There's geopolitical policy uncertainty, longer-term inflation backdrop. There are concerns about debt debasement due to persistently high government deficits across major economies. There's Fed's independence, and so on. So it's a multitude of factors, isn't it? It's not just one factor. How do you respond to this?
You're quite right that fear of Fed independence being under threat, excessive government debt and deficits, creating the risk of either an inflationary resolution of public debt sustainability or even sovereign debt default. But the solution to that is, the right response to that is an investment in a diversified portfolio of real assets, not jumping for a single historically driven commodity. So I can see all these drivers for de-dollarization, and indeed moves away from holding paper currencies across central bank currencies across the world as reserves. But one should move then, as I said, to a diversified portfolio of real, inflation-protected assets, not for a single risky commodity whose only justification for investing in it is that central banks and private agents have viewed it as a valuable store of value, in the case of central banks, for well over 100 years, in the case of individuals, of course, for thousands of years.
But that is exactly the justification that many supporters of gold take, that it has been around for thousands of years and it's worked for thousands of years as a store of value. That you can't create it with a few keystrokes on the computer like you can, paper money. Production growth is limited, so it's not endless amounts of supply every year. I mean, the stuff is under the ground, and so production increase is limited. And that makes it a perfect store of value since it's been around for thousands of years. So how do you respond to that, William?
It remains a highly risky store of value. I mean, from February 2012 to December 2015, gold declined in value by 41%. Right? So yes, I can see the rationale for moving out of central bank currencies. I probably think that some of these fears are exaggerated, but some of them are justified, even when it comes to large industrial countries like the US, EU members and all that. But the solution is never a single commodity without much intrinsic value as a consumer good or an investment good. The solution is a diversified portfolio of real assets, never a single commodity of de minimis intrinsic value like gold.
William, when your piece says central banks should sell gold now, the share of central bank reserves has reached 23 to 24%. Is that a historic high, the highest ever, or have we been at these levels earlier as well? And is that why you're saying that they need to lighten their positions away from gold?
It is certainly a historic high. I think there's no justification for central banks holding a single commodity at all. So I don't think central bank gold holdings make sense. Gold is costly to mine. The average cost, according to some estimates, is about $1,400. And then after you mine it, you melt it, you shape it into gold bars, and you put them back underground again in central bank basements. That is a totally pointless investment, and again, highly risky. If central banks want to diversify their risk, let them invest in a diversified portfolio of real assets, not in a single, totally history-driven commodity like gold.
William, point taken. I have more questions, but I also have to take a quick commercial break here. So don't go anywhere. We continue this anti-consensus view when we ask William to explain some more of his thesis when he asks central banks to lighten up on their gold position. Stay tuned. Welcome back to CNBC TV 18 Prime. You're with me here on the Global Reset. We're in conversation with Willem Buiter, who wrote an article for the Financial Times where he urged central banks who've been big buyers of gold in their reserves to lighten up. We're asking William why he holds this completely non-consensus view. Let's continue this conversation. William, thanks very much for waiting. Now, nearly half of global gold demand still comes from jewelry. Does that consumption give gold any real economic floor? Or is it still sentiment that is driving demand, according to you?
It's a good question. I don't have any hard data to support what I'm saying, or the opposite position, indeed. But I do think that much consumer demand for gold, demand for jewelry, is in fact an investment demand. That people hold it because it is a safe and portable store of value. And I think that must be the case for many holders of gold jewelry in India also. This is viewed not just as something that's pretty around the neck. Actually, I think silver is a lot more attractive for looks, but it is bought and held because it is a store of value. So it is an investment demand, not driven by fundamentals other than the hope and expectation that the price will continue to rise.
William, you note that 35,000 tons of gold held in reserves could be liquidated at significant costs. Do you see a moment where central banks may actually de-gold their balance sheets? And what may lead to it? Is it going to be like a specific moment which kind of leads to this action by central banks, or you foresee this to be a gradual, calibrated process?
Well, I doubt that we're going to see large-scale sales of gold by central banks in the near future. In fact, until 2019 and since 1999, European central banks had an agreement not to sell any significant amounts of gold, because an earlier announcement was by the Bank of England to sell most of its gold, led to a marked drop in the price of gold. So I do think that if central banks are sensible, which they may well not be, they would gradually be trying to unload their gold. I think they should be sensible and only sell it to entities that can afford to lose the entire value of the investment because it is of such high risk. But there is no reason why the central bank, an agency of the state, should be speculating on a single shiny commodity.
William, to any central banker watching, what would you recommend? What would a diversified portfolio look like?
Well, the central bank would have to decide this, I think, collectively, jointly with the rest of government, what the proper portfolio would look like. But if the central bank had to do this on its own, denying its sort of integral location in the public sector, if they do it on its own, I would go for a globally diversified portfolio of financial and real assets. And the financial assets, once again, could be claims that are not as inflation vulnerable as government nominal debt or similar assets like that. This could include equity, could include exchange-traded funds, exchange-traded funds in a wide range, diversified of physical commodities. They would go for the broadest and most diversified portfolio of assets, not exposed or minimally exposed to inflation risk and sovereign default risk.
William, just a quick word on the dollar as well, since we have you on the program. Do you have a view on what happens to the US dollar from here? A weaker dollar is kind of the consensus right now. The dollar will get weaker from here. What is your view?
Well, the factors that are threatening the dollar, such as the need to finance unsustainable public sector deficit by monetary issuance, the risk of loss of central bank independence are not just US issues, right? Fiscal unsustainability is a major issue in the rest of the G7, particularly in Japan and some EU countries, notably France, and formerly also, but less so now, Italy. But so these factors are pushing all dominant global reserve currencies in a downward direction. The threats to central bank independence at the moment seem to be mostly in the US. So that could be a source of weakness. But many of the other factors that are listed as downward drivers for the US dollar are equally downward drivers for the other G7 or even G10 currencies. So I can see a general weakening in the effective exchange rates of the advanced economies, but not necessarily unless the threats to the independence of the Fed become more manifest, not to say a greater weakness for the dollar than for the euro, the yen, and the other major industrial country currencies.
Final question, William. Do you have a view on the Chinese yuan? Do you think with all these concerns around the US dollar and this multipolar world which we are in right now, it leads to some success for China, for them to be able to internationalize the yuan, the renminbi?
It undoubtedly is likely to increase its share in global foreign exchange reserves and as it transactions currency somewhat. They've also moved ahead much more aggressively than most advanced economies with central bank digital currencies. So that's all in its favor. However, the yuan, the renminbi, remains subject to capital controls. And unless it's freely convertible, it is hard to see it as a major, let alone a dominant, global reserve currency. And I don't think the Chinese authorities are likely to give up on foreign exchange controls, capital controls, anytime soon. In addition, of course, if central bank independence is a source of worry for the value of the dollar, certainly the People's Bank of China is not independent of Xi Jinping and of the central government of China, of the Communist Party leadership. So I think quite a few of the concerns that threaten the dollar would equally apply to China. They don't have central government fiscal sustainability issues at the moment, but they have material local government issues, which will have to be addressed probably by central government rescue operations of these local authorities, which would weaken their fiscal position. So yes, I expect that the RMB will increase its share in global reserves, and it may well, thanks to the development of central bank digital currencies, become part of or central to a global sudden non-G7 settlement system, but I don't see any short-term threat from the renminbi to the dollar as a reserve currency or transactions vehicle.
William, great conversation. You're holding on to your conviction that gold is in a bubble, a continuing bubble, and that central banks would do well, according to you, to diversify out of gold into real currencies, a basket of real currencies and real financial assets, as you put it. We'll see, how the call goes as we move forward. Look forward to getting an update with you maybe in a couple of months' time. Thanks very much, William, for joining us here on this edition of the Global Reset. Okay, well, with that, it's a wrap on this edition of the program. Thank you very much for staying with us. More coming up on CNBC TV 18 Prime post a quick break.